Hi, I'm Jim Campagna, founder and CEO of SnapFi. We're a residential mortgage lender helping people purchase homes I've been doing it almost 30 years. So I had a client call me a couple of weeks ago and said, hey, I'm looking at buying a home and I know I'm throwing money away in rent, but I'm not really sure if now's the right time for me. I don't know if I can afford to pay any more than the $1,500 in rent I'm paying right now. And it was great that she acknowledged, hey, I realize I'm throwing money away in rent. So I took the opportunity to ask, what does that mean to you? When you say you're throwing money away in rent, what does that mean? And she goes, well, I don't really know. I know it's bad. I'm paying the man. I'm not, happy with that. And I'd really like to have something of my own, but can you help me understand what it means? So I said, sure. So I went through this scenario that I'm going to share with you, and this is her situation. She was currently renting for about $1,500 a month. And to purchase a home, the payment would have gone up to $1,913. So she's like, can I afford to pay another $400 and some a month? And I think the real issue turned out to be, can you afford not to? So to break down these payments, currently she's paying $1,500 a month, and there are some tax benefits associated with renting, and that is a standard deduction on your tax returns. So if you itemize and take advantage of some of the tax deductions associated with home ownership, you lose that standard deduction, which is worth, in this scenario, about $305 a month, which brought her net monthly rent down to $1,195 a month. Now, to purchase a home of $300,000 with 5% down, that would have been a new mortgage of $285,000. At 4.5% interest, would make the payment about $1,913 a month. So what I want to show is, of that $1,900 a month, how much of it comes back to you? And the tax benefit associated with the property taxes and the mortgage interest being deductible, the income tax benefit works out to be about $425 a month. That comes back in income taxes. And so this is about $120 more than the tax benefit associated with renting. So a lot of people think, hey, I have to wait till the end of the year to get that money back with my tax refund. And you don't. You can, once you're a homeowner, you can go to your employer and get that $120 a month coming back in your paycheck on a monthly basis. The next substantial benefit that comes out of that mortgage payment is the money you pay to principal, which is what I call the money you pay yourself. It's the amount you're reducing your mortgage by every month. In this case, that starts out at about $375 a month. Less the tax benefits and the principal reduction makes the net mortgage payment $1,112 versus renting, that payment is $1,195. So you're better off by about $82 a month. Now, is this substantial in the first month? Probably not. But watch how it plays out over 5 and even 15 years. So in this next slide, as we get there, this next slide is going to show this is kind of a short-term impact. This is what happens over 5 years. So in 5 years, you're going to end up paying $95,000 and some change in rent. And I don't know a landlord that doesn't raise a rent over a 5-year period. So we figured that the $1,500 a month in rent would increase at the rate of 3% per year, making the total over time this $95,000. Now, if you own with a fixed rate loan, your mortgage payment doesn't go up; it's flat, and you would end up paying to yourself in principal reductions over 5 years. You'd end up paying yourself over $25,000. And that's like a forced savings account. That's you're building wealth by paying off your mortgage. And that's only half the good news. The real story and the real value of home ownership comes in my last slide here. So we could take a look at the difference. This is your net worth. This is the value you've created for you and your family over 15 years by renting versus owning. So if you rent, remember you made that down payment of $16,000 and some change. So we figured you're going to keep that money in the bank, and if you earn money in the bank at 1%, you're going to end up with $18,000 over the 15 years. If you put it in your home, you're going to build wealth of $351,000. Here's how we get there. First, your total payments, if you're renting over 15 years, will be $334,000 versus your total payments of buying a home will be a little over $337,000. But of that money that you're paying in mortgage payments, about $96,000 of it would come back to you in the form of principal reduction and $66,000 in tax benefits for a net cost of $174,000. That's your net cost of home ownership over 15 years. If we go back to renting, there's still some tax benefit there, but the net cost works out to be $279,000 a year. So you can see over time, there's a substantial difference starting to form here. How does that all tie in? Well, look, at the end of 15 years, your home is going to be worth about $540,000, and this is based on a 4% appreciation rate. Now, look, real estate values go up and they can go down. We've seen that in the last recession. Certainly in the last 5 years, the appreciation rate has generally been more than 4%. If you go back to 30 years and 50 years, the numbers are pretty consistent, around 4% appreciation rate. At 4% appreciation rate, the value of your home will be $540,000. The current balance on that home would be paid down to $188,000. And you will have created net worth for you and your family of $351,000 versus renting a big goose egg. So this really quantifies what it means to throw money away in rent and pay it to the man. At SnapFi, our team has helped lots of people get started on the path to home ownership. To get started, click on the link to request your own rent versus buy analysis tailored to your specific situation. Thank you for watching today.